Is the carrier network dead? Every day in America, we as citizens witness the tremendous work performed by healthcare clinicians to save lives, offer comfort, and improve the quality of life for millions of Americans. We have many members of our families employed in the healthcare field doing the brilliant work of serving their fellow humans. Surely they represent the best of us, and their light shines brightly on the rest of us. But when we dare to separate the service side of healthcare from the business side of healthcare, we begin to see a strange darkness enveloping the landscape. The business side of healthcare is hiding an ugly truth, which belies the dedication we see every day on the service side. There is a pervasive lack of compassion spreading in the healthcare industry, thanks in part to the relentless pursuit of revenue and profit. The damage to this broken system is adversely impacting some of the most vulnerable members of our US population, as evidenced by inappropriate, suboptimal, and unaffordable care. The US has the highest healthcare spending as a percentage of GDP, but the lowest performance in health outcomes when compared to other industrialized nations, according to the Mirror 2024 rankings. The two countries with the highest overall performance rankings, Australia and the Netherlands, surprisingly have the lowest healthcare spending as a share of GDP. The primary culprit that could be steering this broken system and driving this contradiction is the carrier network. But wait, are not the large carriers nobly pushing back on the greedy hospitals to keep costs in line with competitive market forces? The short answer to this question is a resounding no. The carrier network is concealing an outdated business model and more than a few undisclosed conflicts of interest that are doomed to failure. Our US healthcare funding model is built upon a perverse system that robs Peter to pay Paul, where Peter represents the millions of Americans covered by self-funded employer health plans, while Paul represents the millions of public employee health plans covered by Medicare, Medicare Advantage, and Medicaid. You see, because public employee health plans are systemically underfunded as to reimbursement back to the hospital for the care of members, our large national insurance carriers agree to misappropriate the funds needed for Paul's care from Peter at the self-funded employers to ensure the hospitals are made whole. Put another way, the Medicare reimbursement rates are not high enough to cover the expenses of their beneficiaries, so self-funded employers are sacked for the difference. Covering expenses, yes, but what about profits, you ask? Why, carriers take the additional funds and administrative fees they need from self-funded employers. After all, they need to satisfy their shareholders' insatiable desire for increased revenue growth and profits. Most of us, connected to healthcare, intuitively suspected that the employers were probably subsidizing the system. But as we pull back the curtain with price transparency, the sheer magnitude and brazenness of the model is downright staggering. Perhaps you naively believe that the carriers were somehow reducing their costs of care via their strong negotiating skills and advanced IT systems. Sorry to destroy that illusion. On the contrary, despite contributing thousands of dollars per month in premiums to use a competitive provider network, the private sector employee is now doomed to pay higher prices with insurance than if they had purchased no insurance whatsoever. So much for strong negotiating skills. And as far as advanced IT, the computer systems supporting this house of cards were written in 1960 using COBOL. And have you ever tried to obtain a copy of a provider contract to see what the carrier and hospital had agreed to behind the scenes on your behalf? The carrier will not share that document and rather will insist it is confidential, protected information. This is a bit perplexing given that publishing accurate hospital and carrier prices has been the required law of the land under the Affordable Care Act since January 1st, 2021. While it is not all doom and gloom, the business side of healthcare is getting darker every day. Any changes to the current system will be potentially disruptive to you employers and your member base. The large carriers and PBMs will not accept these changes without a fight. What is the self-funded employer's option without blowing up the system and risking disruption to their members in the process? FinHealth thinks the first step is for employers to adopt a buyer beware mentality. Do not blindly accept the internal control process that purports to be in place. Employers need to be skeptical and verify accurate pricing and compliance on their own. Start with a handful of your largest claims over $100,000. Have your advisor compare the price the hospital charged you to the hospital's own charge master for your carrier. You could also ask your carrier how much they would reimburse Medicare for that very same visit. After all, that is their advertised price. And we would expect it to match the charges on the hospital bill, right? Oregon has implemented an excellent program to cap high-dollar claims at a given multiple of Medicare, say 200%. We at FinHealth propose a modified market economy where price caps are set and enforced whenever a provider chooses to bill at a given multiple of Medicare. Capping spending is like an insurance policy of its own to limit liability under a multiple of Medicare. Long-term, developing direct contracts with the health systems, even if through an intermediary and holding them to it, is the only way to escape the robbing Peter to pay Paul inequity. A national carrier cannot ethically negotiate for a self-funded employer's best interests while they are propping up their underfunded government business and fully insured plans. They have too much latitude to choose to pay hospitals drastically different prices for different customers, what some people might refer to as price discrimination. For the national carriers to really transform their business to a prosper and thrive model, they must offer a more robust and transparent value proposition, as opposed to the smoke and mirrors strategy that carries their business today. We also need innovative companies to begin spreading light in the darkness by contracting directly with providers and hospital systems. Those companies, not burdened by the underfunded Medicare and public employee contracts, will rise victorious in this current market. Who knows, maybe a new health system will advocate for employees by providing a true compassionate care system that is armed with excellent customer service. Employers would certainly consider that health partner to offer a tremendous competitive advantage when it comes to employee satisfaction and retention. For more insight, contact us at sales@finhealth.com.